webinar today. I'm Jyoti from My Time Equity, and we are delighted to have you with us today here. Joining us today are Sudhir Pai and Anup Nayak from My Time Equity. Before we begin, I would like to take a moment to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, My Time Equity takes pride in being your dedicated partner on this financial journey, helping you to plan, grow, and preserve your wealth in with confidence. Sudhir Pai is a founding principal of the firm and serves as a fiduciary investment advisor representative, bringing deep expertise in wealth management and tax efficient investing. Before I hand over to Sudhir, let's take a quick look at the disclosure slide that our attorneys mandate we show prior to every webinar. In the same slide, we have a QR code to join our WhatsApp community to get the everyday update on equity markets, alternative investments, real estate, crypto, ventures, and lot more. If you have any questions during the webinar, please type them in the Q&A box and we'll be happy to take them during the Q&A session. If you like to connect with Sudhir after the session, you can kindly reach us at wealth@mytimeequity.com or call us at 972-330-2771.
Welcome to all the viewers who have joined today's webinar. Thank you for joining. I am here in Florida today, so I have to run to the airport after my slides. So Anup and Jyoti would be taking all the questions. So now let me take you through today's webinar, starting with how the week went. So the week was a very tricky week. The broader indices, while it gained, we really had a big sell-off in Bitcoin. Gold has been a consistent performer, except for some of the gold miners and silver miners took a big beating on Friday, which is yesterday. So overall, S&P gained about 1.7% and Nasdaq 2.4%. It was still a positive week, but overall, the volatility has been very, very high for multiple reasons. The US government shutdown, which has been going on, has entered the 17th day. Most of the government departments are not working, such as the SEC, USCIS, IRS. None of them are providing any support. So there is some impact, particularly given the shutdown at some of the government departments, which impacts the markets, like the SEC for approvals of pre-IPO and things like that. And the probability of the shutdown continuing is 70% as per the poly markets, that it will extend beyond the 30-day time frame. So on Thursday, there was a big sell-off, and primarily the reason is because of two regional banks disclosed that they have a lot of losses linked to suspected fraud, which could mean a $50 million charge on their balance sheet. So this caused a little bit of concern that the regional banks, two regional banks and Jefferies may have issues with the sanity of their balance sheet, and because of that, there was the sell-off on Thursday. But so far, Q3 earnings, quarter three earnings of most of the companies which have announced their results, 10% of SEC of S&P companies have reported, and 82% of them are beating expectations by a median of 7%, which is a pretty good indication that the economy is strong, particularly from the point of view of these large cap companies. And US equities have been going back and forth between its 21-day moving average and little below that sometimes, but it has not broken that at the end of the day. So that means the the index is kind of hovering around that rate. which means the momentum has not been broken. And as we see more earnings coming from the tech heavyweights, and we will see that coming from next week. Tesla and Netflix are the two companies which will kind of set the tone of the market. And after that, we will see Google and Microsoft report. So, the next few weeks are going to be extremely important weeks for us to get a confirmation that the earnings of these companies will continue to be good. And usually Q3s are, kind of made up year because it is in the last quarter of the year. And usually window dressing takes place in Q4 because most of the institutions who have been sitting on the sidelines and the hedge funds who have been shorting the market while the retail trade has been really pushing the market higher, there is usually potential for better purchases from these institutions, because of which we will see good weeks in the month of November and December. So with this correction going on, slight correction, it's not a heavy correction. The week still ended positive, but Bitcoin usually is kind of gives an indication of what might happen. And we had the options expiry yesterday, which is Friday. And with the next 2 weeks being a little bit of volatile week because of results, because of all the tweets that are coming out from President Trump's Twitter, as well as the geopolitical tensions that are going on, and finally the seasonality. A market that has seasonally done so well has to have some corrections. So this correction is good in my opinion. It gives you an entry point. If you want to enter market with more money, this is the buy the dips moment in our mind. So we let's see how it goes next week. But in my opinion, next week is also going to be a very volatile week. Next slide, Jyoti. Okay, so where is the smart money going? That's the subject of today's webinar, and we see the smart money now going into small caps. Small caps have been, uh, sitting in the back seat for a long, long time. And as you can see in the chart, small cap versus large cap, the breakout has happened. But small caps are very volatile. So even though there is a breakout, some kind of negative sentiment or any information coming from the Fed about Fed being more hawkish because inflation is going to prop up again. With all of that, small caps can be very volatile, and it can whatever upside we get to see in few weeks can become downside very quickly, and that happened in 2024. 2025 is a very different year because interest rates are on a down slope because Fed has clearly said that interest rates are happening, and all the jobs report clearly show that interest rate has to come down, even though the tariffs are inflationary and we see all these metals kind of really going with so high. That certainly means that the input pricing for most of manufacturing will continue to only escalate, and we should see inflation prop up. But as of now, inflation seems to be under control. The new reports are not getting generated because government shutdown is going on. But overall, everything looks good, and we have 2 more months for the year to end. So follow the trend, which means small cap can be one place where you can put some of your allocation. And in our models, most of our overall models, the custom model, the margin model, all of these models have allocation to small caps of anywhere between 5 to 10%. That's the overall allocation we have to small caps. So small cap is certainly one place where the money is moving right now. Next slide. As you can see, the EPS, the earning per share for small cap, has been very strong. Even last year it was pretty strong. The projections are more or less consistent. But the challenge is the Fed. if the Fed does not cut interest rate, that's what happened in 24. The expectation of Fed lowering the interest rate never happened. It just happened in September. The next two cuts, which should happen, in October, November, December, 3 months, that should give a boost to all the small caps to get to the next level. And the fundamentals support it. That's what this slide shows. Next slide, please. What about gold? Gold has moved so high. The question is, will it continue to push higher? And the primary reason why gold has moved up so high, right? It has been low lying from last 12 years. The upside has really not been felt from the last 12 years. But suddenly from the last 12 months, we have seen a huge uptake. And why is that? That is because of the debasement rate, which means most of the central governments are today buying gold versus accumulating dollars. That's why you see dollar going down in value and gold and silver taking off. Silver typically follows gold. There has to be a set ratio between gold and silver. Now that ratio is being is coming into picture and it's kind of getting factored in. That's why we are seeing continuous uptick in gold and silver pricing. And for the first time, we in 30 years we are seeing foreign banks now are holding more of gold versus US treasuries. So they are dumping US treasuries and they are buying gold. And this is one of the concern that the US government has, and that is called as the debasement rate, which means will other nations dump dollars and start accumulating other store of value assets such as gold and silver and platinum, palladium, and bitcoins. So that is where we are seeing a run up in gold pricing. And now the question is, will this continue? So in my opinion, this may have a small consolidation, but it will not drop huge because the fundamentals of this metal has changed. If central government starts accumulating, there is no reason for them to sell because they have started accumulating for a reason. So we may see some amount of slight, trading related, trading impacted the correction, but not really huge sell-off or anything like that. So we are not going to reduce our allocation to gold or silver. We are keeping it on, but our models will certainly see the impact of any corrections, short-term corrections or to gold and silver. And that is what we saw yesterday to our models. Our models had a little bit more, on the downside compared to the broader index. Next slide, please. The next place where the smart money or the global fund managers are sending their cash is the emerging markets. Emerging markets have really done very well, particularly the likes of South Korea, Vietnam, Greece, Indonesia, South Africa. They are all up more than 50% year to date, which means there has been some amount of de-risking from the US equities because US equities are very expensive right now compared to the global market. But at the same time, US companies are performing, the innovation that is going on in the US with respect to artificial intelligence, robotics, and tokenization. All of this is certainly making US attractive, but the valuations kind of make it a little bit concerning to put all eggs in one basket. Hence, money is also going to other countries. And also, given the tariff concerns and tariff issues, China is likely to ship products to several other countries, and that those products will show up in US, Europe, and other countries via other countries, and that can really give a boost to these other economies as well, the smaller economies. And not only that, US is also trying to leverage other countries for its resources. So that is also giving a good boost to some of these other countries. And given that inflation is higher compared to the past, we have to see equities go up in value. So the most important thing today, which one should not be doing, is keeping cash in the bank account or keeping cash in treasuries, because treasuries, the interest rate is going to come down eventually, and equities is going to go higher. And it's important you keep your money in growth assets, such as equities, gold, rather metals, and cryptos, and also invest in assets such as real estate and things like that, because over the last 3 years, real estate has not really done anything. And real estate is a good time to enter, in my opinion, because as interest rate starts going down, uh, real assets starts picking up in price. So emerging markets are certainly one of the diversification ideas for your portfolio. And I'll take you through our models in some time so you can get an idea on what we are doing. Next slide. No, question is the US bull market over? As I said, US is expensive right now, but at the same time, the earnings of all these US companies, and with the likelihood of Fed lowering interest rates and the prices of some of the currencies such as dollars going down and the price of oil coming down, all of this can balance inflation, and lowering the interest rate might give uh, impetus, a stimulus to uh, small cap and mid cap equities and the other value companies in S&P, and that can really bring back. And this bull market, in my opinion, should continue. And if you look at it on the historical data, since 1950, the average bull market has lasted approximately 5.5 years. And we have been in this bull market for about 3 years. So this started in October 2022 when NVIDIA first announced its AI chip. So, I think we still have about 2.5 years left for the bull market based on the historical numbers, and which means there is potential for further upside if these historical numbers hold good for this current bull market as well. And my personal opinion here is, AI is just starting, as we all might have experienced. So when you use an app like ChatGPT, it doesn't give you 100% what you want. There are a lot of issues in it, and those issues need to be uh, sorted out. And all this capitalization that is going on in terms of build-up of data centers and need for energy and build-up of nuclear reactors next to the data centers. All of this, in my opinion, is not ending till this complete infrastructure is built. While there is a bubble created, a bubble formed in the US in the because of the AI hype, I think the burst of this bubble might only happen sometime by end of 26 or by early 2027. Or, if there are more catalysts like the interest rate cuts and the big beautiful bill, which lets a business owner write off investments in equipments and real estate, those type of stimulus certainly gives a big boost to equities. And that is what I'm hoping here will happen over the next 1.5, 2 years. So US bull market is certainly not over. US equities are strong. Other markets are also strong, like emerging markets, metal markets, and the crypto markets. There is a lot of meat still, in my opinion. So we are long in this market currently. Next slide. So coming to macros, given the government shutdown, a lot of the macros, the data releases from the government departments are not happening. We are not seeing jobs report. We are not seeing inflation reports. So while macros are uh, supposed to show up on October 23rd, Thursday and Friday, let us see, if this government shutdown ends. And the other big catalyst is the earning. So next week it will be the turn of Netflix, which has been a little choppy because of certain comments made by Elon Musk. And Tesla, obviously, Elon is now focused on his companies. So we should see more good news coming from there and company doing well in terms of stock price. Then we have Procter and Gamble and IBM, which are in the software space, giving some idea what a big 30,000 pound gorilla like IBM would have to say, about the technology and what it is going to report. Next slide. So coming to the performance of our models, S&P was up 1.7 and Russell was up 2.38. As I said, money is going to small caps and gold continued to be up with 5.28% for the week. But if you see on Friday, we had a decline of almost 2%. And that reflected in our portfolio. If you look at the custom model and the margin model on the right hand side, we took a bigger beating on Friday, about a percent down. But still, on an year-to-date basis, we are doing extremely well. S&P is 14% versus our uh, 19% in the margin model, and 14.28%, after a 46 basis point reduction, certainly is a good one because we know whatever has happened to Bitcoin and whatever has happened to gold in the last week is going to change going forward as by the dip events take place. So Bitcoin saw a huge drawdown of almost 9%, and that affected our model. But again, we are not buying and selling stuff. We are staying put. And when it comes to growth versus value, as you can see, growth was ahead of value. So the growth was around 1.63% for the week, and value was 1.24%. And international was up 1.45%. So overall, we see the trend of small caps going faster than large caps. Still, we see some catalyst results or earnings coming out of these companies. So let's see how the next week goes, and based on that, we can have clarity on large versus small versus international versus metals. That clarity will get a little bit more crystallized in the next 2 weeks. Next slide. So that kind of is the market wrap up, folks. Now coming to our fund, we launched a My Time Equity Tax Efficient Income and Growth Fund. We shared information about this fund last week as well. So this fund is a fund that is a very diversified fund. It has its investments in real estate, plant and equipment, and machinery, equities, metals, and digital assets. So if you're trying to make your investments in everything that I talk about, this is the place where you need to invest. So it has a hold period of 5 years. The minimum investment is $25,000. We will make quarterly distributions, and there are huge tax benefits out of it. Next slide. Next slide. Yeah. So there are three pillars in this fund. One is real estate, one is business ventures, and one is security. So the first two pillars generate huge amount of depreciation, and the third one, which is equities and structured notes and metals and crypto, these are growth assets. So overall, 65% in depreciation focused investments because of the big beautiful bill, but still earning decent return and growth. And the growth side of the pillar, the pillar three is where huge growth is going to be positioned here. We are hoping for a much bigger growth compared to real estate and uh, you know the business ventures. So overall, this makes it a very tax efficient play. Next slide. So at a high level, what does it mean? So we have three points to talk here. One is the first year depreciation. How much depreciation am I going to make for 2025? So if you invest $100,000, the lowest depreciation that we are expecting you to get through the K1 is 2.1x, which means $210,000. And the best case, the highest depreciation that we will achieve by end of year one, which is for 2025, which you can take on your 2025 tax return being filed in 2026, is $260,000. So I think it will be somewhere around 2.2, which means if you invest 100K, you can write off 220K. And coming to the on the income side, okay, I got my depreciation for 25. How much money am I going to make? So you'll make anywhere between 3 to 6%, more or less, around 4% is my opinion. But we have to see how much money will be raised in this fund and how much money will be invested, and what would be the depreciation on each of the properties that you're buying, and investment in cattle and plant and machinery that we'll be making, because plant and machinery and cattle gets almost 100% write-off, and real estate gets about 90% write-off, and the stocks don't get any write-off. So overall, you're looking at around 2.2x write-off, around 4% income, and the total return when the money is returned back at the end of fifth or sixth year, you are looking at a total return of around 1.6x. That is because we have growth assets in the fund to the tune of almost 30-35%. Now again, this is based on our pro forma, how we have worked out the numbers based on our understanding of the current market and projections of the future. Future cannot be exactly like the past. So there are always risks with the projections because nobody knows the future. But since we have been in this business for around 4 years now, and in the tax practice for more than 20 years, I expect this fund to do more or less between the base case and the best case. So, so try our fund, if you're looking for something which is diversified and gives a pretty good write-off and income and growth at for year 2025. And we are going to bring one such fund every year. So this is the 2025 fund. We expect to close this by end of the year by around December mid. I think we are not going to take any more money in this fund. So currently, we are seeing a lot of interest. So please look into this if you are seriously interested. We do have other investment opportunities which generates tax benefits, such as oil and gas funds, uh, some of the charitable contribution funds, and we have our car wash programs as well, which gives more or less similar returns. But you can be part of one asset rather than, a diversified pool of assets. So depending on what you are looking for, we have that particular product to offer. Next slide. Next slide. Okay, cool. So coming to structured notes, we have this one note issued by Bank of America, and the trade date for this is October 22nd. Don't have a whole lot of time. And this note is on Broadcom, Facebook, Snowflake, and Intel. So there are four stocks. So this gives you 51% return if all these four stocks are flat or positive at the end of year one. If it is not, then every quarter the bank will check, whether all the stocks are positive. If they are, then you get 12.75% per quarter added to the 51%. So if all the stocks are positive in year two, for example, you would end up getting 51% multiplied by 2, so close to 102%. And if it is not, it goes to year 3, and at end of year 3, if all the stocks are positive, you make 153%, still giving you around 51% return per year average. And at the end of year 3, and if the stocks continue to be down, and if it is not below 30% from its purchase price, then you get your money back. There is no loss of capital. But if it goes below 30% over 3 years from the purchase price, that is when you will have a loss. So let's say if Broadcom is down by 50% at the end of year 3 because it has consistently remained down, or one of the four stocks have remained down over the next 3 years, that is when you will have a loss. So this structured note is structured for those who believe in these four companies, will be very happy with 51% return per year if it goes for 3 years. Otherwise, most likely, this money will be called and you will be getting only 51% by end of year 3. And at the end of year 1 or 2 or 3, depending on when the money is returned, it will be a long-term capital gain. So this is not monthly income because, a lot of our clients pay a lot of tax, and that's why we talk about tax reduction. In these notes, the growth notes, you will see long-term capital gain, which means lower tax. You will be paying 20% tax. So I like this note a lot because they are four solid companies, all in the AI space and doing very well, and large cap companies. We never do uh, a structured note on a small cap or a meme stock because the risks are very high, and our barriers are between 30 and 50%. Like in this case, it is 30%. And usually we have a 3-year corridor because things change in the span of 3 years. So if market comes down, it goes up eventually. And 3-year period is a good time for us to kind of go through that volatile market. Next slide. So this note is with three tickers: Palantir, Nvidia, and Tesla. And this is a income note. It has income of 19% per year, and it gets paid on a monthly basis, so 1.583% per month. And this has the memory feature, which means if you end up missing any of the month's payment, you will end up getting it back because we have included this additional feature. And then we also have a feature called one star, which has been added, which means if any one of these stocks are positive, then the other two are disregarded. We don't consider whether they're up or down. So that may gives a little bit more protection. And because of those two protections that we have added, the memory feature and the one star feature, we are looking at 19% return. These additional features become expensive sometimes, and the returns go down. So if these features were not included, I think we could have negotiated a 25, 28% return from Morgan Stanley, but we wanted this protection because Palantir is at all-time high. Nvidia and Tesla are also very high. So we wanted to get a decent protection with these two features and also a 40% barrier at the end of year 3. And banks can call this note after 6 months. So there is a 6 months no call option. Banks cannot return your money back to you. Next slide. So the third note which we have is a very good note for those who want full protection on their money. So this is an FDIC protected uh, structured note, and this is on futures. And S&P futures actually run faster than S&P. So the returns of S&P futures has been phenomenal from the last 2 years, 3 years. So this note with the much more aggressive ticker, we thought we should get a principal protected note with the FDIC insurance. So up to $250,000 investment in this, it's totally protected. And what is that you make in this? It's a 5-year note. So let's say, there is a big correction or a recession in the market in 26 or 27. We have this as a 5-year note. So even if the market falls, it has to come up in 5 years. And since we see point to point, which means we buy this note on 31st October 2025, and we see it again, on 31st October 2030, and nothing happens over these 5 years, you can always sell this note. Our past investments in this index, the futures index, it is right now up by almost 28%, while the market S&P 500 is up by 13%, which we saw. This note is up by 28% or so. And what you're going to get additional here is a 20% more, you know, on the real growth. So at the end of year 5, if S&P has grown up by, let's call it, 300%, then you will end up getting 20% on top of it. So you'll get 60% on top of the 300%. So, uh, so a 20% additional growth over and above the S&P futures return. So this is beautiful. So you get the upside of another 20%, but the downside is fully protected, including the FDIC insurance. So this note is one of a very unique note that we have brought to our clients. So take advantage of it for those who want to protect your money. If you want to put this in an IRA or some kind of a protected asset, I think this is where you need to put your money. And if you want to put much large amount of money in this, we can certainly uh, discuss at length with you and explain how has this index done in the past 30 years. Because SPX is the market, the SPY, but this is a futures index. Futures index has really done very, very well in the past 30, 40 years. So we expect this to do very well. And with additional protections, we have no problems in taking the risk of putting money in the futures index. So please take a close look at it. And if you're looking to invest a large amount of money, I am totally fine with it because, up to $250,000 there is FDIC protection, and about $250,000 there is principal protection by the bank from Morgan Stanley. Next slide, please. Okay, this note we presented last week as well. This is on Bitcoin and gold. As long as these two metals, two assets, one is digital metal and one is the real metal, as long as these two are positive at the end of year 1, you make 30%. And this keeps going on with 30% per year or 7.5% per quarter till both these tickers are positive. And if it is not, which is very unlikely, because over 3 years, you can't have metal and Bitcoin, which are both store of value, to be down for 3 years. So in my opinion, these two will be positive by end of year 1, and you will end up making 30%. So, 30% is a very good return with the downside protection from a commodity like gold and then a digital asset like Bitcoin, a very volatile asset, but still, source of value, a store of value, and continues to go up in price. We saw Bitcoin go up to $126,000 highest price, and 2019 the lowest price, 2024 the lowest price we saw was $19,000. So you can see the wide range of volatility that goes in Bitcoin. But Bitcoin certainly is a scarce asset, and the value of it, even though it drops, because it's traded 24 bar 7 and very, very, easy to transact. Volatility will be normal. People want to make money because it's easy to sell and buy. So selling and buying is, since it is so easy, people do play with it. That is where the volatility comes from. But if you ask how strong is the asset, in my opinion, it's a very strong asset. And each one of us need to have anywhere between 2 to 10% of our portfolio in cryptos. And that's why we have the crypto fund as well, the Time Equity Digital Asset Fund. So talk to us if you want more information on any of our funds. So currently we have the tax efficient income and growth play. Then we have the car wash program. Then we have the My Time Equity Digital Asset Fund. We have the Opportunity Zone Fund for lowering capital gains tax. So there are a lot of things, folks. So please join our WhatsApp group. Scan this QR code and join our WhatsApp group to get daily updates and all the offerings. Reminder to you that we do these weekly webinars. We spend a whole lot of time. As you can see, I am here in Florida and still, not missing out on my commitment of doing the weekly webinar. And Anup and Jyoti are also here. They will take all your questions. But please do join our group, get educated, make smart decisions for your finance. Don't rush, don't get FOMOed, don't run behind returns without any protection. While we are also projecting big numbers, we have enough protection in place. That's the most important thing. Take risk with protections and your wealth will grow. So there is a saying that, it's not hard to make money, but it's very hard to keep money. It's not what you earn, it's what you keep. Uh, it's not what you make, it's what you keep in your life. So it's very important to, retain your assets, do well, grow it nicely, compound the growth, and ensure that, your asset goes from one generation to the next. And that is uh, what My Time Equity does. We plan your legacy. That's why our tagline is Legacy Wealth Planners. So thank you very much. I need to run, but we'll have Anup and Jyoti take questions, and please type them in the Q&A box, and we will take them. And if there are any questions which Anup is not able to handle because it's connected to some things related to the funds, then we will either call you or shoot you an email or a WhatsApp message giving you the answers to your questions. Thank you very much, folks, and wishing you all a very, very happy Diwali. Thank you.
Thank you, Sudhir.
Thanks, Sudhir, for the session. I know in spite of your busy schedule, there are a few questions that we'll try to answer, and there are a few questions that we'll get back on that. So okay, so first question is regarding the FDIC insured fund. So the first question is, some of the structured notes are FDIC insured and some are not. Does it mean that they're not insured or supported by FDIC? Yeah, so basically, yes, if there is not, if it's an FDIC insured, just like how your deposits are insured in your bank, these principal up to 250K is also insured. So wherever you have an FDIC insured tagline, please be reminded that it is having an FDIC insured, and most of the FDIC insured funds are also principal protected. So that is regarding the FDIC insured fund. And so what could be the amount if I can receive of 1 second, there is one question regarding yeah, so there is a question, what could be the total amount I can receive on the 5-year SPX note if I invest 50K? So the answer is, if SPX futures does not do well, it is negative after 5 years, your 50K is given back to you. That is what the bank is assuring with the principal protection. And let us say SPX FD is grown by 100%, then your returns would be 120%. So on a 50K investment, you get 60K as gain. So totally 110K would be credited back to your bank account. I just give an example of 100%. Even if it is 10%, then you get 12% gain, because everything has to be multiplied by 1.2. Okay. Next is there a way I can invest in notes through my 401k Fidelity brokerage account? Absolutely yes, especially if it is an old 401k, old IRA. Not only these structured notes, but we have got other investment which we have not spoken in this particular session, but we can definitely invest in the structured notes and also in other investment. Please feel free to drop an email to wealth@mytimeequity.com. More than happy to schedule a sessions, and we can go through all the investment that can be done through your old 401k, right? Yeah, I think there was yeah, so regarding 3 to 6% target return, is it quarterly interest return or yearly? So it is an yearly projection that we have got. However, the returns would be given on a quarterly basis starting March 31st, 2026, right? So you'll have to divide by the quarter on whatever is the yearly projection that we have got. Okay. So far, these are the questions that I can see, Jyoti, unless or until I'm missing something, but these are the questions that has come. Okay, if there are no further questions, then I think we are good to wind up. Again, wishing you all a happy Diwali and have a nice weekend ahead. Over to you, Jyoti.
Thank you, Anup. Thank you all for joining our webinar today. And as informed by Sudhir, if there are any other questions which is related to other funds, we will get back to you directly, and our team will connect with you, and we'll take them forward. Thank you, and wish you all a very happy and prosperous Deepavali and happy weekend. Thank you. Bye-bye.